Good day, this is Jeff Christian from CPM Group. It's the 23rd of July. On the 22nd of July, CPM Group issued a market commentary called Precious Metals Rise on Investor Concerns and Market Mechanics. That market commentary is available on our website if anybody wants to read it. It's www.cpmgroup.com. That market commentary is posted there. And basically what we were saying was that over the last 2 days, up until yesterday, the price of gold, silver, platinum, and palladium had risen sharply. It was a very interesting move because it was all four metals, which tells you that it wasn't specific to any given metal, but it didn't spill over into copper or oil. Oil and copper actually were down yesterday. And have been relatively weak, and it didn't spill over into other commodities. A lot of times when you see metals prices rise, it's across the entire commodity span, but this time it was just the precious metals. As we looked at it, we saw several things. First off was there's increased concern about the state of the economy and politics globally. We have seen the EU have a really interesting conversation over the weekend that extended into this week and came up with a multi-trillion-dollar stimulus package. There were people who were concerned about the inflationary implications of that, which we think is ill-founded, but much more importantly, the fact that they did this and came up with a multi-trillion-dollar stimulus package is indicative of the weakness that is inherent in the global economy and the European economy. At the same time that that's happening, the US government is talking about further stimulus, which again emphasizes the fact that the economy is not out of the woods by a long mark. And in fact, even though we've seen some positive economic data in the United States over the last couple of months, there are severe short-term and long-term economic problems, and the financial system continues to be problematic. People look at the strong stock market and they say, well, how come you have such a strong stock market in such a weak economic conditions? And the answer is because the government's pumping tremendous amounts of $3.7 trillion of money into the economy, and a lot of it's not going into the economy. It's staying in excess bank reserves, which are being used as collateral for derivatives on the stock market and the currency market and the interest rate market. So you're seeing the financial markets way out of line with the economic reality behind them. And in that kind of environment, investors started buying gold and silver. You took out some technical points. You got silver over $20, really for the first time, maybe second time since 2014. Gold took out some technical points and shot up toward 1890 today. Gold continued to be strong today. Silver, platinum, and palladium have fallen. Platinum rose a little bit, palladium started to rise as well. So you saw the precious metals rise. Part of it was economic concerns on the part of investors. Part of it was the view in the case of platinum and palladium that the auto industry will recover, at least it's recovering in China. There will be economic stimuli for buying new cars and trucks. And so that should help the auto catalyst industry, which is a significant part. You're also seeing, especially in palladium, some increase in electronics demand because there are so many people who need computers at home and they don't have them. They need them for their children to go to school and they need them to work remotely. And there's a view that that should help electronics demand. But the big impetus in the industrial demand for platinum and palladium is really on the auto catalyst side. At the same time this is happening, you have a very large open interest still present in the August COMEX gold contract, and you have large open interest in the September silver and palladium contracts. You had more than 28 million ounces of gold open interest at the beginning of this week in the August contract. That needs to be rolled forward. And that applies upward pressure because what you find is they buy the shorts, the people who are short the August will be buying back their Augusts and they'll be selling October and December contracts. In silver, it's a September contract and you'll see people buying back their silver contracts and rolling them to December. And that has the effect of pushing the prices up on a short-term basis on the spot nearby prices. We saw this last year, and in July and August of 2019, the prices of gold and silver started to rise very sharply. A lot of people got very bullish on gold and silver, and we warned at the time that the economy was not in a recession. We didn't have a pandemic. Interest rates were relatively low, that we thought that this was primarily a function of people rolling August gold and September silver forward. And it was. If you look at the silver contract over the course of July and August, there were like about 800 million ounces of September COMEX silver contracts bought back by shorts and covered by rolling forward. You had about 28 million ounces of silver ETFs bought in August up until the very end. And most of those were actually bought after the price had risen. Get back to that in a second, maybe. And you had about 1 million ounces of silver coins. So the buying action that drove prices up in July and August of 2019 was primarily short covering on the COMEX. And we warned our clients about that and said, look, once September, the September COMEX roll is over, these prices could come back off. Took a lot of flack from people, well, one person or two person people in Vancouver who really wanted to believe that, investors were waking up and they were buying silver and the ratio was 80 to 1 and it couldn't stay that high. And we said, no, it really is a function of the September contract. And when the price fell, it fell sharply after September 5th, and it fell then September, October, November, and most of December. Only started rising late December and early January again. And that was different. So what we saw last year was really a lot of short-term, technically inspired buying and short covering. 2020 is not 2019. So our expectation this time is that we're seeing some real demand. You are seeing those September rolls and the August rolls in gold, but you're also seeing some real demand. Coin sales are not up that sharply, but they're not off that sharply. They're higher than they were in May and June, month to date in July, but they're not nearly as high as they were in March when the pandemic first hit and the global economic lockdown caused a lot of people to rush into physical gold and silver. But 2020 is not 2019. It's radically different now. So we do think that the prices will stay strong for the next couple months through August into early September. We do think that the prices will pause after that and probably come off a little bit, but we're not looking for 4 months of price weakness and a significant decline the way we saw in the last 4 months of 2019, because things are different now. We have a much worse economic environment. We have a financial system that's out of line with the underlying economy. We have massive political problems in the United States for sure, but really around the world. And Brexit is coming, and all of the discussions that needed to be had to try to resolve these still insurmountable differences between Britain and the European Union have not been had because of the pandemic and the lockdown. So Brexit is coming, and it's going to cause problems and havoc. You have issues related to a movement away from the LIBOR interest rate benchmark to something else, most of which don't seem to be working too well or too effectively right now. You have regulatory issues across the financial markets. You have political problems in the United States. You have an election coming up in the United States. You have the US sending 2 aircraft carrier fleets, which is about 40 ships, into the South China Sea. At the same time, we're claiming that TikTok is, I don't know what it's doing, destroying the youth of America, and ordering the closure of the consulate from China in Houston. We're seeing a tremendous amount of international as well as domestic political uncertainty. And all of that's coming together to keep investors interested in gold and silver. And platinum and palladium to a lesser extent, they're really more responding to the view that the auto industry is going to respond. Again, the market commentary, which is shorter than my comments on the market commentary, is posted at cpmgroup.com. You're welcome to get a free copy of it. And if we can help you in other ways, we will. We'll probably do another commentary next week, early next week, on the price relationship between gold and silver. we've been pulling some numbers together, talking about how silver tends to outperform gold in bull markets most of the time, not all the time, but most of the time. And also looking at the gold silver ratio because other people look at it. That's it for today. Hope that was useful and enjoyable and entertaining and informative to you. And we'll be back to you next week. Bye.